I think big thing takeaway is that it's not so much pros and cons of, hey, should I buy residential or should I buy this? It's how can you utilize those 1 to 4 units as a stepping stone to, potentially build up enough capital or personal net worth to be able to start making moves in the larger multi-unit space. And as we pointed out, experience is a key factor, and that personal net worth is a key factor. So, if you can show a good history of being able to manage 1 to 4 unit rentals, that's definitely going to help when you want to go purchase that 10, 20 unit apartment building. And having that liquid net worth, you have multiple empty lines of credits available, that's going to be able to help you on any repairs, maintenance costs, stuff like that moving forward.
What's the difference between financing a single family property and a multi-family property? Well, in today's video, we sit down with Josh and Ehren from the Findlay Mortgage Team and really discuss what's the big deal. Is there a difference? Which one should you focus on first? Do you need to go small before you go big? I know that as a new investor, you likely have a ton of questions, and we're going to dive into them in this video. What is up, YouTube? Matt McKeever here, and we've got Josh and Ehren again from the Findlay Mortgage Team. Hey guys, how's it going?
Hey, good. How are you?
So today, based upon one of your guys' requests, we're going to be breaking down exactly what the difference is between single family or small residential properties and larger multifamilies. So let's kind of think of it as the 1 to 4 range and the 5+ range. So we're mainly going to talk about finances, but we'll even kind of loop into how that maybe impacts your ROI. But when it comes to single family versus multifamily, where should we start?
Yeah, I think first thing is just, why did we want to talk about this? Obviously, we've had a couple of people just ask on the differences. And it's really just to bring to attention some of the differences in cost of acquisition, the qualifying process, and then, like you mentioned, what the return overall on your investment is in terms of cash flow and potential appreciation down the road.
Yeah, we are seeing a huge amount of investors move into this multifamily space, especially in the last 12 months. As property values are increasing, though, we're finding that the questions around multifamilies are becoming more prevalent in our day-to-day interactions with our clients. So we wanted to really break down, what the advantages of that's going to be, and we're going to start off with qualifying. So as most of you know, or most investors know, qualifying on the residential side for a 1 to 4 unit is based off your own personal income and your debt ratios. So essentially, a bank is going to take a look. How much debt do you have? How much income do you have? Do you fit within the box? If you fit within the box, you qualify. Now, there's a handful of ways for investors who are first getting into the investment space to purchase multifamilies without putting 20% down. Now, definitely advantage there, but on the qualifying side, you're essentially only capped at how much you can stretch your personal income on paper. So one of the pros in the residential side is, the high loan to value. So you can get an insured mortgage product. The rates are definitely probably the cheapest you're going to get. And the rate hold. So if you're looking to purchase a property, you're able to get a rate hold, and in that time frame, you're able to go and purchase a property and have a locked-in rate. Whereas on the commercial side, that's not quite the case.
Yeah, and then keeping on the residential side, some of the disadvantages or the cons is that you're qualifying based off your personal debt servicing. So the biggest target market that we see affected by this is the business for self market. Owning your own business obviously has a higher cost of performing. We often see a little more leverage on lines of credits and credit cards. So you're carrying higher balances. When you're qualifying on the residential side, you're using a 3% monthly payment off those balances. So that often increases the amount of debt that we have to service. A lot of the business for self markets write down their income, so they're using smaller amounts on their taxes and what they're making gross overall. So those all play into the amount of debt that you can service and your affordability. So disadvantages there is just that, you have potential to really, kind of hurt yourself on the qualifying. And same with just even non-business for self T4 regular employment individuals. If you don't quite make higher end salaries, obviously that limited income plays into effects on your GDS, TDS ratios, which are the key factors that we take a look at. So you really rely on your income to debt ratio, and there are some disadvantages there on the residential side.
Yeah, so when we get into the 5 units and up on the commercial side, some of the advantages of it it's based off the actual debt service coverage ratio. And I know we've gone through it a few times, and I don't know if everybody can wrap their head around the concept of it, but you don't need to qualify with your personal name. And that's one of the main conversations we're having with a lot of business for self people or people who are looking to scale rapidly but don't have the income to show is, this is a great way to be able to get into a property with multiple units without needing to qualify, and show a lot on paper, because most of the people who are business for self are cash heavy. They have a bunch of cash, but from a bank's perspective, it's great you have cash, but if you can't service a debt, they don't care. So, this is a great solution to start scaling your portfolio and take advantage of the tax situation as well.
Mm-hmm. And then some of the disadvantages, because they're looking at the rental income and the heavy reliance on that rental income, if you're looking to purchase a vacant building or any building that has complete or partial vacancies, you do affect your ability to qualify because of that heavy reliance on the rental income. They aren't on the commercial side as likely to just allow you to slap a fair market rent in there and say, hey, this is where it's going to be. Let's use this to qualify. On some of the really large apartments, they may take a look at CMHC and where their values are and use a nominal value in there. But on these 5 units, they really want to see that building qualify at the time of purchase. If you can get a legit lease in there before the actual purchase date, we can use that. But if you're looking at renovating some units, they're not going to allow you to use that market rent. They're just going to use a 0 for that placeholder, and it can affect your ability to qualify, and you may have to put a little bit more down to decrease the mortgage amount to help with the debt servicing. Another disadvantage is kind of the heavy reliance they put on personal net worth. Again, this is getting a little bit larger into those probably 12 plus type units, but because they take a look at a little bit larger of expenses than they do on the residential side, they're taking a look at any potential management costs and maintenance fees. They want to know that if you had vacancies for a month or 2, depending on how long it was, do you have some sort of liquid net worth or liquid cash flow to be able to support the mortgage payments during those times of vacancies? If there's any large expenses, a roof has to be repaired or a bunch of doors have to be repaired, windows, do you have, again, the liquid reserve to be able to go in there and make those changes to keep the structural integrity of the building safe? So they do put a little bit higher reliance on that. Or on the residential side, they don't necessarily have that reliance. So a little bit of a disadvantage there when looking at the small business side. And then experience overall. Again, we're still looking a little bit on the larger, but even on the 5 unit side, they do want to know what your experience is. If you're brand new, you've never bought a building before, jumping into a 10-plex by yourself, they may have some questions and maybe a little bit of pushback. So they take a look a little bit more of the personal profile and take that into account after the debt servicing of the building.
One of the main actually pros that we forgot to talk about is when you're purchasing commercial property, 5 units and up, you can purchase through a holding corporation. Now you can do it on the residential side too, but it's not as effective. Whereas if you purchase it your commercial property through a holding corporation, it really allows you to take tax advantaged situations and scale your portfolio. It also allows you to be able to buy in your personal name when you do want to buy a house, and a handful of other advantages that your tax guy can obviously outline as well.
Mm-hmm. The next kind of key point that we want to talk about is just the down payment differences as well too. So on the 1 to 4 unit residential side, there's 2 options when you're looking at getting into a rental property. There's an owner-occupied purchase, which is going to offer you the strongest loan to value that you can get. So on a 1 to 2 unit, 1 obviously being a single occupancy, but on a 2 unit, you can do a rental owner-occupied. You can get away with a 5% down payment, so a 95% loan to value. And then on a 3 to 4 unit, you can use a 10% down payment. So you're at that 90% loan to value. So minimally getting in with a lower down payment keeps that cash in your pocket. If you're looking to burr the property, a little bit more cash towards the renovations or closing costs, whatever you want to allocate that towards. And then on just a standard rental property, uninsured, you're looking at a 20% down payment. So definitely gives you your best options to put the least amount of cash down on front on the acquisition of the property.
For sure. Some of the pros or advantages of being able to purchase residential property with an insured product is you're able to scale a lot faster and have more units faster than what you would if you were buying an uninsured product, I guess. So you can use 10% and have a place to live and have 3 cash flowing units, which is definitely ideal. And we're seeing a lot of new investors take advantage of this. Now, it's very difficult to be able to BRRRR an insured property just because of the equity position you have. But if you're looking to get into a property and maximize your first purchase, taking advantage of that minimum down payment and getting the most units for that minimum down payment is definitely an advantage.
Yeah, absolutely. On the cons, there is the CMHC premium attached when you do these insured products. So like Josh just mentioned, it does affect your equity position greatly. So if you're looking to do a BRRRR and it's an insured purchase, if you take a look at a 95% loan to value, so you put 5% down, there's a 4% CMHC premium on top of that. So effectively you have a 1% equity position. So just to be able to refinance and switch your rate out, you have to build 19% equity into the property. To be able to pull out money on top of that, every little bit above that 20% equity position now becomes your cash flow. So realistically, you're looking at building in 30 to 40% equity into a building to be able to pull out any funds on a BRRRR. So it does make it a little bit more difficult. With a strong market, it definitely helps with the way the properties are appreciating, but when you get back into a more normalized market, it's pretty difficult to force appreciate a property to build in 40% equity position into the property.
Yeah, so one of the cons obviously with that is there's no VTB options allowed as well. So if you are purchasing residential property, you can't use a vendor take back or seller financing option, whereas on the
And you mean for like your down payment?
For your down payment source, that's correct. So if you're looking to purchase conventionally with a bank isn't going to allow you to use a vendor take back or seller financing to acquire the property.
Small caveat with that is if you do go to a credit union and want to buy a 1 to 4 unit, they may allow you to use a vendor take back, but traditional conventional lenders, there is no VTB option.
Guys, so for the 5 units and up, for the down payment, you're looking at around at least a minimum of 25% down payment. These commercial loans require at least, that 75% loan to value. Now, depending on where your property is, if you're buying a actual property that is performing and it meets a certain debt service ratios, and that down payment is going to be 25%. Whereas if it doesn't meet those ratios, you are going to have to increase your down payment to make that happen. So the down payment is really reflective of the property itself as you're purchasing it as is, and not quite your personal qualification, which is either advantageous or not advantageous depending on the type of asset you're purchasing and your strategy, whether it's active or passive. If you're buying a cash flowing property and your whole idea is to hold that, but it's not quite where you need it to be in regards to rent, that can be extremely difficult to acquire if you don't have the liquid cash available.
On that 5 unit side, taking a look at just some of the advantages, there are CMHC options available for multi-unit buildings. So you do have the potential ability to go up to an 85% loan to value and a 40-year amortization if you're under the CMHC. There is, again, premiums on top of that. When you get those maximum terms, it is about, I think it's 4.5% on the max for the commercial side, but it does allow you to get in with a little bit lower loan to value. Again,
So if I can just jump in there for a second, because you can do the CMHC, but I'd love to hear your guys' perspective, because I think a lot of people hear that 15% down and they're like, oh, that's what I'm going to do. And they're just like, I heard once that you can do 15% down, so I will just refuse anything that's not 15% down. In general, when we're buying properties that need to be stabilized or value add opportunities, what percentage of those deals are actually CMHC deals?
Yeah, none.
I don't think.
Yeah, zero of them. If you guys are buying an underperforming asset, it's not going to work. Even if you have a performing asset, half the time it doesn't work. Like the CMHC has their own internal valuation model. They will value their property internally as well as their own debt servicing ratios. And those certain ratios are going to be reflective of the type of loan they're going to give you. There is a time frame that takes to be able to acquire CMHC financing. That's why it's usually made when you're on takeout financing after you reposition a property, because the average person doesn't have 60 to 90 days to close a transaction. There is also a handful of fees involved, and not all the time. Like, it's not every single time that you're going to get accepted with CMHC financing. They only look for the best buildings, and it has to fit within a very strict framework to allow them to be able to move forward with your financing. So when you are thinking of CMHC financing, think of it more as takeout financing for when you bring the property to where you need it to be. Like if you are buying this thing for your kids, bring it to where it has to be, and then take out that 40-year amortization, super low payment, and live off the cash flow. If that's what you're looking for, that's the perfect product. But purchasing a property is very unrealistic with CMHC financing if it's distressed.
Yeah, I just wanted to save you guys like 1,000 emails that were going to go nowhere.
Appreciate it.
Yeah, and not to jump into it too much, but I have had a few clients looking to do purchases on CMHC, and the loan to value wasn't as high as they were looking for. The amortization was not where they were looking. I think it was at 30 years, which is great, but it's not the 40-year. And the rate wasn't as all where they were looking. A lot of the guys who want that CMHC, they're looking for either the huge loan to value or their super low rate. Most of the values in terms of the rates I've been seeing are around 2.3 to 2.5. So when you kind of take a look at it in the grand scheme with a 25 or 30-year AM, with an insurance premium on top of that as well too, and potentially even a higher loan to value on the purchase, which means you're getting more mortgage amount, which means a higher mortgage payment. You got to really take a look at the cash flow, and does it make sense for you to do that if you're looking from a cash flow basis, or does it make sense for you to do an uninsured purchase and take a look at at that same loan amount with potentially the same rate, taking a look at how that saves your cash flow. So quite a few different things to take a look at when you're doing that multi-unit insured purchase or refinance.
For sure. When it comes to the 5-unit plus down payment side too, there is no sliding scale. So as many of you know, for residential property, or if you don't know, there's a sliding scale. Usually, downtown Toronto is about 1.5 million. Most lenders will do 80% conventionally, and then everything after that's either 50 or 65% that you have to come up with. So that can drastically affect your ability to be able to purchase property if you aren't extremely liquid for your down payment source. So on the commercial side, there is no sliding scale. Your down payment is your down payment, which can be definitely effective if you're purchasing larger multifamily or commercial property.
Mm-hmm. And then of course, the VTBs on the small business and the commercial side of lending, they do allow you to have a vendor take back as long as the building is able to debt service it and cover the payment. They definitely are okay with that being a source of down payment for the purchase.
Yeah, some of the cons or some of the disadvantages to this or purchasing 5+ unit commercial property would be the down payment. Just it's a little bit more than what you would buy with a single family home or a duplex. So you have to have a little bit of cash behind you to be able to purchase these properties, as well as the down payment scales to the DSCR. So as I said previously, if you're buying an underperforming asset and you want to get conventional financing for it and it's not meeting the minimum requirements, you need to increase your down payment to bring those servicing requirements in line. So it could cause you to have quite a bit of cash in the project on acquisition, which might not be the best bet. That's why the private market does exist. So if your loan to value is at 65, maybe getting that 80% loan to value private loan and then quickly repositioning the property and refinancing makes more sense than putting extra $200,000 or $300,000 down on a property and not using it to reposition the asset.
Yeah.
So just to give like a little real life example and where the differences in down payment are at between a 5-unit plus and a 1 to 4 unit. If you had a 4-unit building or a 5-unit building, let's say, and you wanted to get into the building and do some renovations, if it was completely vacant or maybe only had 1 unit that was tenanted out, that rental income isn't there to support the debt servicing on the building from a commercial or small business standpoint when we're looking at just debt service coverage ratio. Now, if you wanted to purchase a 4-unit building on the residential side that was vacant and had no rental income, but you had enough personal income to support the debt on the building and the ratios were in line, you could easily get into that building with just a 20% down payment. So that's kind of one of the examples that you might see the differences in how the down payment works and the requirements from a lender.
For sure.
One of the other things we want to talk about is just personal covenants and the strength of the borrower. Taking a look at the personal net worth statement and the experience. On the residential side, they don't necessarily take a look at the personal net worth of the borrower themselves. There are some net worth products out there that can be used, which can be advantageous. But in terms of just general lending, they don't put as much emphasis on the personal net worth and the experience that you may get with the commercial lending.
One of the things we actually have been seeing probably within the last 12 months since COVID started is some of these conventional monoline lenders are requiring a minimum of $100,000 verifiable net worth through many different types of ways. You could have cash, stocks, equity in a property, but to buy a rental property now, they're requiring some sort of net worth, so people aren't necessarily just going into properties and not having the capital required or that they would feel comfortable with somebody being able to scale their portfolio. So that's a kind of a change we've seen in the last little bit. But other than that, there isn't really a whole lot of kind of strength or emphasis put on somebody's personal net worth statement when purchasing residential property.
Yeah, I mean, it's just on the residential side, it really just looks good. The more assets that you have, it just adds that strength to the portfolio until it doesn't.
Yeah, until you have too many, and then it doesn't.
Cons, I mean, for our rental purchase, some of the lenders are requiring the $100,000 in net worth. And it's simply just because of the reliance that's put on the rental income when qualifying. The lenders look at it and say, if this rental income isn't there, do they have the cash reserves again to cover the mortgage payment, cover any rent repairs or maintenance to the building? And in some situations, if there's a property management company, do you have the additional funds to cover that? So they're really just making sure that the borrower can maintain the asset throughout any situation that they may run into.
For sure, and that's kind of the same with like 5 units and up to the commercial side of things. Like that capital reserve is it's not like there's not a specific number that a bank is going to be looking for. It kind of scales depending on the size of the project and how much debt they're going to be servicing. But they do want to see you have the ability to be able to take care of the costs, like a roof, for example, or having changing a boiler system. That could cost $10,000, $15,000, and if you're purchasing a property that is only cash flowing, say $1,000 a month, that's great for you, but what happens if you have some serious capital expenditures? Can you take care of that and make sure that that's going to be serviced properly?
Mm-hmm. Yeah, just touching quick on the CMHC, there is a small net worth requirement with CMHC financing on the commercial side, so it's 25% of the value or a minimum of $100,000. So there is that net worth requirement when you're doing multi-unit residential insured deals. That they don't necessarily have that requirement on the 1 to 4 unit insured side. So just something to be aware of. And then cons, taking a look at the disadvantages when you're in that 5+ multi-unit, there is a lot more emphasis put on the personal net worth and the experience. So like Josh just said, they want to make sure that you have the ability to cover any maintenance, cover any vacancies. I have a couple clients right now that are looking to purchase a more business type asset. We have the numbers that work, but they want to see the lender wants to see a little more strength on paper in terms of personal net worth, and they're kind of using that against them and decreasing the loan amount. So even though the numbers work on paper, the lender's putting a lot of just emphasis on their strength and the personal net worth, and they're kind of getting the loan reduced based off of that. So the lenders will take that into consideration on the multi-unit side, and depending on what it looks like, they can decrease the loan to value on purchase.
And we're kind of touching on the video we shot last week, but this is why you work with a credit union or you work with a bank that you have a relationship with, because if you can show the strength to that banking or financial institution and they understand the assets that you have and the cash flow that you have, it's easier for them to be able to approve a loan or find a creative solution to get you in. Cash
flow and ROI is something we wanted to touch on quick as well too. And basically the kind of point that we want to bring to here is what does your return on investment look like versus the down payment requirements and the cost to get into a building. Those 1 to 4 unit buildings are getting up there in cost right now. Single family homes themselves are going anywhere from $500,000 to $900,000 depending on what market you're looking at, whether it's London or the GTA area. When you take a look at what the cost of a multi-unit building is, when you can get a 5 to 10 unit building for $1 million to $1.5 million in some of these markets, what does that internal investment look like when you have 10 units cash flowing versus 1 to 2 units cash flowing for 90 to 100% of the same cost on acquisition? So basically just looking at, taking a look at how cash flow affects buildings on the residential side. There are some lenders out there who use a rental worksheet, and they'll take a look at essentially what they call like a bit of a debt wash or a surplus deficit. And it basically takes a look at how much cash flow is coming in on that building. Most lenders are going to utilize 50% of that income, and they want to see that income support the mortgage payment, the property taxes, and usually the heating costs. Whatever the surplus is, we add that back into the other income, or if there's a deficit, we just decrease that from the income. So cash flow does have a small part to play on the residential side. Not as large as the commercial side, but it still plays a part. And then we have the B lenders who can really utilize that rental income. You know, they'll do a 80%, even 100% rental offset for one of the lenders that we that we work with, and allow that to offset all the expenses of the building. And that really drastically decreases your qualifying GDS TDS ratios. And on the B side, we often see that the more rental properties you have, as long as there's a pretty significant cash flow, it actually increases your ability to afford new properties because of the use of rental offsetting and decreasing your effect of your liability. So it can be quite a strong product to use on the residential side if you have good cash flow.
Completely agree. Yeah, having investors understand having cash flowing assets, even like say you had 4 cash flowing assets, like heavy cash flowing assets in a portfolio, that's drastically going to change your ability to be able to qualify for more assets, because most of these lenders will only take your top 4, top 5 cash flowing assets, use the income, and then for the rest of the assets you have, they're going to use just all of your monthly debt obligations towards that property. So as long as they wash out or you have a surplus, it essentially allows you to wash all the properties away and qualify for your personal residence and the property you're looking to purchase, which is how people get into 6, 7, 8, 9, 10 properties while still showing, say 100 or 150 grand total on an application, which is how most of these B lenders are finding creative ways to get into real estate. One of the cons, obviously, for single-family homes or 1 to 4 units is on the conventional side, just on the A side, we're only able to use 50% of the rental income. So essentially, on the A side, you can only scale so far because you're only using 50%. You're adding it to your gross income. For anybody who doesn't understand that, you have your personal income that you qualify with, and then you service all of your debt. So if you take the rental income, you cut it in half, throw it up into your gross income, your total income now has to qualify for all of the debt that you're going to be purchasing plus what you have, which again, 50% of rental income means you're still qualifying, hopefully, on 50% of the expenses on the property if you're using a 1% ratio, which you can only scale so far.
Yeah.
When you get into the 5-unit plus, there's a couple things that we take a look at. Obviously, the more units you have, the more cash flow you have coming in per month. So, one of the advantages is additional cash flow. You have multiple units, you have that higher cash flow. That rental apartment type space as well too, you can get a pretty decent return on investment per unit. We're seeing some of these units go for $1,500, $1,600 on a rental apartment. So when you have 10 of these units cash flowing at $1,700, then you're getting quite a healthy return month over month on that cash flow. Additional services. Additional services as well too. You're able to bring in income from parking, coin operated laundry as well too. So you have the ability to add in additional income. And I guess you could on residential as well too if you wanted to put in a coin operating machine. I don't know how many people are doing it on the residential side anymore, but we do see it on the rental apartments as well too. So just the availability to have those additional sources of income to come in, and you can use those on qualifications with the commercial properties. They will consider parking and laundry income and any other verifiable source of income that you may be getting on that property.
Yeah, and one of the most advantageous things about commercial property, which the majority of investors are focusing on, is the ability to be able to rapidly increase your ROI or the value in a property. As soon as you start increasing the net operating income of the property, the value goes up because it's based off of cap rate. It's no longer based off the comparable sales in the area. And that's why people are purchasing these distressed properties, is because they're taking low rents, they're renovating and turning it into high rental properties, taking the cash flow, increasing the NOI, and that NOI is effectively creating a much higher value in property, and then rinse and repeat. People they take the cash out, they buy another asset, and they do the same thing. So that is the main driver for the majority of our investors right now, is the ability to be able to have control over the value of the property other than just doing renovations.
Yeah, and I think one thing to touch on that's really prevalent to this current market right now is, even though that cap rate has a beneficial side to it, there is a bit of a disadvantageous side as well too. And we're looking at cap rates right now in Cambridge, Waterloo, Guelph, Hamilton in that 3 to 5% on these multi-units. when you take a look at historical rents, they just don't keep up to the appreciation of the building. So when you have a really hot market like this, and these multi-units are going, $200,000, $300,000 over asking, and those rents are still at the rates they were 20 years ago for some of these buildings, we've seen rent rolls not change. It's very hard to qualify with a DSCR when those rents are just nowhere near strong enough to cover the cost of the building. So there is advantageous sides when you're looking to maybe burn it out and increase that rental value and increase that building value. But on the reverse effect, when you're trying to get into a building and those rents just aren't anywhere near high enough, you're going to have to look at some sort of alternate solution to get into the acquisition.
Yeah, I really see in the short term, probably within the next year, a large niche market forming in the private lending space or the capital space because of these values are increasing and rent isn't increasing. It's going to be harder and harder for somebody to be able to access these properties because it's not meeting the debt servicing ratios. So it's essentially cutting a bunch of people out of the market unless you have money. So I think that the private market is going to step up and start creating solutions for these investors to be able to go at higher loan to value, get in and do what they need to do.
Mm-hmm. And the last thing that we want to just touch on is just overall cost of getting into these buildings and managing the buildings. On the residential side, we're typically looking at a lower purchase price. So obviously down payment's going to be a little bit less. Your land transfer tax is going to be less. Your lawyer costs are going to be less. And if you're purchasing a private or a B-side type product, your fees are going to be less just because your loan amount is going to be less. So overall cost of management is going to be generally less on the residential side. Once you get into those 5-unit plus multi-units, purchase price starts to go up. So you're going to have just higher down payments in general. Plus loan to values are at 25%. So you're getting a 5% increase there just off the top. Land transfer tax obviously goes up when you're purchasing commercial. Your lawyer fees are going to be a little bit higher. Basically, it's just all relevant on the purchase price. So once you get into those larger purchase prices, your typical costs overall are going to be going up.
Yeah, and I think one thing to add to that as well is when looking at your input costs during your due diligence process, right? So like if we're doing it on that small res, there's probably a decent chance that we're not even paying for the appraisal. Or if we are paying for the appraisal, it's only like $300-$500, right, to buy it. Whereas if we're looking at that larger commercial property, multifamily, it's not unusual if we've got to do a phase 1, a phase 2, you get an inspector in, you pay for the appraisal, which is going to be a couple $1,000s. Oftentimes when we're looking at apartment building, it's not unusual for our due diligence cost to maybe end up at like $20,000-$25,000 out of pocket before we know we're buying the property. So I think it's also important that people go in eyes wide open once they're starting to get into these bigger buildings and just realize like there is going to be a little bit more capital needed even on just the front end, right?
For sure, yeah. We've definitely seen some people who didn't maybe recognize or understand the total cost, but they end up going firm on a multifamily property. Definitely realizing that the phase 1, the environmental, the building condition report, the appraisal report, each one of them are like $2,500 a piece, and that's not including if you need a phase 2, which is roughly $15,000. And as Matt said, it can get very expensive very quickly. So understanding your total cost and capital allocation needed to be able to even start playing in this sandbox is really important.
Mm-hmm. Mm-hmm. I think big thing takeaway is that it's not so much pros and cons of, hey, should I buy residential or should I buy this? It's how can you utilize those 1 to 4 units as a stepping stone to, potentially build up enough capital or personal net worth to be able to start making moves in the larger multi-unit space. And as we pointed out, experience is a key factor and that personal net worth is a key factor. So, if you can show a good history of being able to manage 1 to 4 unit rentals, that's definitely going to help when you want to go purchase that 10, 20 unit apartment building. And having that liquid net worth, you have multiple empty lines of credits available, that's going to be able to help you on any repairs, maintenance costs, stuff like that moving forward. So that 1 to 4 unit residential space is really just an initial stepping stone to help get you into the larger commercial space. I think it's a little unfair to just directly compare the two, but there are some people out there doing that. So just utilizing it as a stepping stone, getting into the larger space.
Yeah, really appreciate you guys breaking down this subject matter, because I do think as we continue to see a lot of pressure, especially on the residential side of real estate, a lot of us investors naturally start drifting towards the larger units, and it is a slightly different game. It's important that you guys understand the different aspects in regards to these games so that you're making sure you're in alignment with it, because again, a lot of people think, okay, cool, sounds good, I'm going to go buy an apartment building, but do you have the $25,000 to make sure you can just easily do the due diligence? Are you comfortable raising the type of capital necessary, or do you have the personal capital? So again, really appreciate you guys breaking it down. And real estate's so contextual and so location oriented at the end of the day. To really understand if you're going to be able to pull off this deal, you're just going to have to reach out to like Josh or Ehren, go through the application process and really understand what's going on with this specific deal in your specific situation to see whether it's going to play out right. So again, link to all their contact information in the video description down below, guys. Make sure you grab it, and really appreciate you guys coming on the show.
Yeah, thanks for having us, man.
Thanks again to Josh and Ehren for taking the time to shoot this video. If you guys got value from this video, smash that like button, hit subscribe if you're new to my channel, and let us know what real estate strategy are you currently implementing in your market. Are you going after small multifamilies? Are you going after single families or large multifamilies? Let us know what your niche is in the comments.